Okay, Michael, happy Thursday. I almost said happy Friday. Happy Thursday, December 22nd. We're going to talk about tax codes changing, deals that we're looking for. We're looking for distressed assets right now. Rates are still kind of crazy, going up and down. And most importantly, we're getting ready to send out a year-end update for our investors. Calvin and I are working hard, and so is Lyndon, at compiling those numbers. So lots to talk about today, but Michael, thanks for jumping on.
Absolutely.
And thanks, Chad and Jose as well, and everyone else that's going to be listening to this later. Something really important that I want to talk about is depreciation, tax codes. And number one, we're not CPAs, we're not giving tax advice, but we do really feel this is important to talk about, Michael. And it's not the reason we invest in these deals, but it's a huge bonus to get these great tax write-offs. So one thing that we do whenever we buy a property is we do a cost segregation study, which allows us to depreciate a huge amount of the property. You know, we're never going to hold these properties for 27 or 35 years. That's a typical depreciation schedule. What the accelerated depreciation and cost segregation study allows us to do is write off those amounts in a much shorter time period. So initially, when you buy a commercial property, you can get some very nice tax write-offs. Now, some people average around 50% of what the investor invests back to them as a write-off. I would say that's fairly typical, but everyone's different and every property is different. Now that looks like it's going away. We will no longer be able to write off as much in 2023 as we have written off in the past. That tax code was changed in 2017. Was made to help investors out and to kind of help the market out as far as multifamily and commercial goes, and to give good landlords and investors a tax break for being good operators. So we'll see what happens. They may end up renewing that. They may extend it. They may not. Probably not with the current administration. I doubt taxes will go down. So we'll see. But Michael, just for example's sake, just in your own life, how have these tax breaks played a role as far as cost segregation and buying? I mean, you investing well over $14 million in the last few years into real estate. Can you talk just from your personal experience as far as these tax breaks have helped you out? You don't have to give exact numbers, but just to give these investors an idea of how much they've helped you out.
Well, forget about me for a moment. Yesterday, the day before, Donald Trump released his tax returns.
Yeah.
And what most people unfortunately don't seem to understand is that the reason why guys like him and other people make $100, $200, $300, $1 billion in a year and not pay any taxes is because the tax code is set up not for the poor middle class, it's set up for wealthy people to buy assets, specifically real property assets. You cannot do this with stocks. You cannot do it with Bitcoin. You cannot do it with art. You cannot do it with Rolexes. The last thing you can do this with, aside from a few other businesses, oil, other businesses, why Warren Buffett buys the businesses he buys? Because of depreciation. Yes, they're cash flow businesses, of course. You're not going to buy something that doesn't cash flow. But the cherry on top of whether it's Warren Buffett or what we do, or what any real estate person is doing, that is investing in large portfolios of multifamily buildings, is they get this thing called cost. They get rate depreciation, tax write-offs. So how does it affect it? Well, if you put $5 or $10 million into a piece of property, and you have a $20, $30 million loan, and you're getting back on every dollar, you're getting a 50 to 75% break in taxes.
That offsets a lot of income.
It offsets a lot of income. So there's different types of income. There's passive income, there's earned income, there's portfolio income. This is considered in the IRS's eyes passive income. So it's taxed at a much different lower rate than when I get a commission check. When I get a commission check, I have to pay 50% to the state of the feds and another 13% to the state of California.
Yep. So again, Donald Trump paid zero taxes, and the way he does that is he buys assets. And let's go into the thinking of why the IRS has done this, because they did this on purpose. The government does not want to provide housing. They know they are not good at it. They do it a little bit, there is government housing. They really don't want to provide housing across the country. They're not good at it. It's not something they can do. And so they said, okay, how do we incentivize these investors, these people with money who are good operators who can provide housing? Well, we need to give them a tax break. They need to be able to make money. So if they can make money and provide good housing for the United States people, then let's do that. So that was the thinking behind some of the tax breaks, a lot of the incentives, the loan programs that the government helps put out, Fannie Mae, Freddie Mac, those are all good government programs or government subsidized programs. The IRS and their tax code, they need good operators like us to provide good housing. And that's what we do. We put a lot of money into our properties, we fix them up, provide a really nice community for people to live in. And as a result, we get great cash flow. And we also have in the past gotten really fantastic tax breaks. So I'm guessing that this will get extended or reinstituted, something like the current tax code, as soon as we get maybe a new administration, or the current administration sees the recession type situation we're in and the economic situation we're in, and they see the market really slow down and they want to kind of incentivize people to grow and build their portfolios and deals to happen. And so I think we'll see. But the biggest thing is if you're looking at tax breaks, investing money, this is the year to do it. You have 2 weeks left to invest your money, or less than 2 weeks at this point. Go ahead and invest is my suggestion. Talk to your CPA would be your next suggestion. Find out what's going to happen with taxes, but it will be a different environment come 2023. And we'll see what Donald Trump does, but I'm sure he'll find a way to not pay very much taxes again next year.
There's always a way.
Yeah. So the next thing that I wanted to talk about, Michael, is, we said to talk to your CPA, but also talk to, I think people need to talk to people in different part of the country. They need to talk to their bankers. And specifically, we're talking to loan servicers right now. So if you're a real estate agent, my piece of advice would be talk to people that are doing mortgages. The guy that was just on, I was talking to him about mortgages and who's struggling, and if he can get me in contact with these loan servicing companies that are local, and we can find some deals. We can find some deals here in Utah. Maybe you guys can find some listings and find people that are struggling, that have these really high variable rate loans or ARM loans, or who just got in over their head and now the market's not as hot as it was. And so as a realtor, Chad and Jose and everyone else listening to this, I would just talk to bankers, talk to loan servicers. You can probably find a lot of deals. And one really exciting thing that we're doing right now is we have access to Bloomberg's engine, their data engine. And we are looking up everyone that has a variable rate loan, an ARM loan that's coming due soon. And there's a few other metrics that we're looking at with a DSCR, or debt service coverage ratio, under 1.25. And we are looking for people that are distressed, owner operators that maybe can't pay their mortgage, maybe rates went up enough that it really affected their deal. And my feeling, and Michael, I think you share similar sentiment, we're going to see a lot more of that in the next few months. Unless rates really drop, there's going to be some people that run out of money, that realize they have to sell. Not it's a good time to sell, they have to sell. And that's what we're looking for right now.
We haven't seen it yet. I don't know that rates are going to drop. And right now, thank goodness they've settled a little bit, because we're refinancing. We're going to be refinancing Fairmont 4 to go from a LIBOR loan to fixed financing. But we're not seeing a lot of sellers in great distress. There will be operators that even in normal times make mistakes, and they're going to have to sell. I just don't know right now. It's an interesting time.
Yeah, I don't know. I think there's a lot of people suffering in silence.
Yeah.
Just imagine on the Cleveland deal, if that was a tight deal, if we didn't have the wiggle room we had in that deal. I know there's people that bought deals that didn't have the wiggle room.
Right.
Cleveland, that's the reason we felt comfortable moving forward on Cleveland, had a lot of wiggle room. So I know there's people suffering in silence right now. The San Antonio deal my team just underwrote, Michael, I don't think we told you this, seller had to sell. His debt service had him negative cash flowing 20,000 a month.
Right.
He went from positive cash flow to negative cash flow, just over 20,000 a month. And to give some people perspective of what rates did in the last 6 months, people that had maybe a debt service of, let's say, 35,000 a month, which is similar to a few loans that we have right now, rates have in some cases more than doubled their mortgage payment. So if they were paying 35,000 a month, maybe they were cash flowing 10 to 15,000 a month. Rates caused their debt service to jump to 70, 78,000 a month. Well, there goes your cash flow.
Right.
And in fact, now you're negative cash flowing and taking money out of reserves, maybe taking money out of your rehab budget, but that money is going to only go so far. And so this San Antonio seller didn't have money in his reserve account, didn't have CapEx money, and basically just wasn't paying his mortgage. So he had about 3 months to sell before it was going back to the bank.
Yeah.
So I think, Michael, I think we'll start actually seeing that pretty soon. I think there's some people maybe not being honest about the situation they're in, but they can only hide that for so long.
We shall see.
We shall see. Okay, so the next thing is we are working on an end of year, I guess, end of year recap. So recap of the last 2 years, actually. And Michael, I know you're super data driven, super detail oriented. We're going to do a big picture. What did we project versus how did we do? And then how did we do and how do we expect to do the next year? And, investments are always changing. That's why it's, we tell people this is never guaranteed, never for sure, but we always have a contingency plan. And so a number of our properties, Michael, have completely switched. Like we have completely changed business plans. We have always had multiple options and multiple exit strategies, but at Fairmount 4, we're considering selling at this point. It's gone up in value enough where we may consider selling, or we will do a cash out refi or just a normal refi, but we've got multiple options. And same thing with San Antonio. It's not cash flowing where we want it to, but it's come up in value a ton. We may just sell it. We may just pull our cash out. Who knows? But what I do want our investors to know is that we're in a really good position. We gave ourselves enough wiggle room on these properties to make it through this high rate environment. And we're going to be very honest with you in the next 2 weeks when we send that out, the first of the year, of where we think we're going to be in 2023. And we're going to be conservative. We're going to hold back cash. We're not going to distribute all of our cash. We're going to hopefully do the right thing and prepare for higher vacancy in a recession type environment. And we'll see what happens. But I feel really good about where we're at. I feel good about our operations, and we're always improving. And I feel really good about waiting and keeping our powder dry and finding some deals that are distressed. And I'm really excited for that. Michael, as one of our biggest investors and also board member, if we sent out a report, what would be a few things that you would want to see as far as what we projected, how the property's done? I mean, cash flow is an obvious thing. I think people want to know what the properties are worth as well. What else would you want to look for, or what would be your advice to these other investors who maybe don't have as much experience as you to look at? And because we want to be transparent. So what questions would you be asking?
I think that you can't lie with the numbers. The numbers are the numbers. And so the question becomes, is the property operating at the highest level of efficiency? Is it being managed properly? Are rents rising? Are they falling? Are we exploiting the situation if they're arising? Are we really handling expenses the way they need to be handled? Is the communication open and effective between the team? Is it constant? Is it transparent? Those are the questions that I would look at and ask. I mean, you and I talk quite a bit during the day. The whole team does quite a bit during the day, during the week. And so, we're constantly trying to refine and keep things as efficient and as strong as powerful. So, but legitimate questions from someone that doesn't have inside information on that would be, again, the things that I think you and I have talked about. Is the property doing well? Is it not doing well? What does the prognosis look for 23? Is it realistic? Is it conservative? Are you taking risks that don't need to be taken or should not be taken? And is MFI communicating clearly and effectively with investors to what the investors think is important? Those are the things that I would look at if I was not involved.
Yeah, and I think sometimes our investors don't always know what questions to ask. They want to know where cash flow is. So we're going to update them on, we'll do a much broader or in-depth, update on each property. I'm actually going to do a webinar that's going to be very lengthy, and I'm going to go through the rehab budget for each property. Hey, here's what we projected everything would cost. Here's the variance. We have all that data. Here's how much we have left to spend on each property. Here's the projects that turned out to be more important, that maybe gave us a higher ROI. So we're going to get really nerdy with these investors of ours and give them an insight on these day-to-day decisions that we've had to make. And like on Terrace Hill, I said to our property manager, do we really need to do shutoff valves? Because there was like one shutoff valve for 15 buildings for the hot water. So anytime there was a leak, 15 buildings went without hot water for a couple of days. She said, yeah, if we could eliminate to maybe just having one building have a shutoff for a couple of days, I think we'd have a lot happier tenants. And actually, that's one of the big reasons tenants move out. I didn't know that when we bought the property. I knew that we wanted shutoff valves. I didn't know it was such a big complaint. And so we actually took money out of some of the repairs we were going to do on other things or upgrades on other things and reallocated about $60,000 to the shutoff valves.
You know what I think we've learned, the team has learned in the last 48 hours, that sometimes, many times, managers, they're not really business people. They think like managers, which is to make sure that they get tenants in and people are happy and the toilets are clean and the grass is green, that sort of thing. What we're constantly having to coach our managers is to anticipate things that will come down the next month, 2 months, 3 months that could possibly negatively affect cash flow. We have sometimes managers that allow contractors to submit a bill 2 or 3 months after they've done the work and expect to be paid that month. And all of a sudden, a bill that should have been maybe $2,000 to $3,000 a month as they went along becomes $13,000 to $15,000. All of a sudden, you have a $15,000 matzo ball that is about to blow into the cash flow and severely hurt it for that month.
It's exactly why we moved to quarterly distributions, because you can't control these contractors and PMs that hit us with a massive bill all of a sudden.
Right. So what I'm training and you're doing to train the managers is that we want to know in real time, and we are going to insist in real time, week to week, month to month, that there are no contractors that are not being paid in real time as they submit the bills. It is not acceptable to not pay people as they go and then have any surprises down the road. There should be no surprises in 2023 for billings. None that could affect. Now, we can't control utilities, we can't control taxes, we can't really even control rents. I mean, people are going to pay what they pay, and occupancy, we do the best we can. But what we can control is to know that every quarter, for example, certain utilities are going to spike. There might be 3 payrolls in one period versus 2. And if we have a certain amount of massive amounts of terms like in F1, where it's a yearly thing or 2-year thing where 20, 30, 40 people might move out at one time, of course, it's going to be filled quickly. But during that time, there might be cost of turning the units, cost of cleaning the units, that could cost after 3 months, $15,000, $20,000. Well, we want to pay that as we go, not get a bill from the summertime that hits November and seriously affects cash flow. That is not
It's not
okay.
fun.
That's no longer to be tolerated.
Yep, and I think you'll love the system we're putting together. We spoke about it a little bit, but you know, we are realizing we have to really be babysitters in a lot of
Yes.
situations for these contractors. And
Yes.
so, you know, we just hired a new general contractor for the Ogden, Utah property that we're buying. We're closing on it this Friday. And, you know, you're a board member on that deal, and you'll see a lot of this, but we're actually hiring a virtual assistant team to update the tracker. You know, the tracker that we use for Cleveland, we've got that for every property now. And this virtual assistant team will get pictures and videos of every project that's done and watch for quality control, verify that what we're being charged for was actually installed, which we've actually found a number of contractors when we did our Desert Peaks audit. In some apartments, 30% of the work that we were billed for wasn't done. And so we're telling these contractors, yeah, we're not paying you. We're actually not paying you for any of the work until you do what you put on the bill, what you were basically hired to do. And so anyways, we have this virtual assistant team working hand in hand with a general contractor. The general contractor does not get paid any month that tracking sheet with all pictures and videos is 100% updated. And then our bookkeeper does not cut checks for any contractor if that spreadsheet is not updated. So talk about putting systems into place. And, you know, I wish we could just rely on these property managers and contractors to track everything that they're supposed to track and turn in bills on time and report bills on time and pay bills on time, but we can't. And so we're making this kind of a foolproof system across the board. Nothing gets paid, no one gets paid, and work doesn't get signed off until the tracker is 100% updated. And so I'm really excited for that to roll out. This Ogden property is the first time that we're having the VA work directly with the GC, and the first time that we're having the GC sign a contract saying that he will not get paid a dime until we have pictures and videos of every unit that's being worked on, proving that the work has been done. And he's good to go. He's excited. He actually has a military background. Chad's on, so he'll appreciate this. 10 years working with systems and operations in the military before he became a general contractor. So this will be easy for him. And we're really excited to put that system into place, but he'll be our guinea pig. And moving forward, I'm just not interested in working with anybody that can't provide weekly updates for us so that we're on track. I mean, it's really not that hard. It takes a little bit more time, but really to touch on how important this is, we had a GC that got sick for Terrace Hill, Michael. I don't know if you even heard about this, Michael. It's a crazy story. He got sick. He actually has cancer, very sad, but he had a couple foremen that he set in charge of our property, and he sent them out to do work. And so what we did to make it easy is we had all these hand railings and soffit fascia that needed to be replaced out of wood rot. We took spray paint, Michael, and we spray painted an X on everything that needed to be replaced. It's a pretty simple system. We also gave them a list. Said, here's your list. Here's everything you're supposed to replace. We walked the whole property with them with spray paint. We marked an X on everything that was supposed to be repaired and fixed. Well, 2 months later, we got a bill for $38,000 more than the quote they gave us. And we said, well, what's this? They said, well, that's all the handrails that we replaced. And we went and we had verified that they had done the work that we asked them. What we didn't think to do was to check other handrails that they were not asked to do, because they had also done those ones. So they had done $38,000 more work than what we had asked them to do. They had done handrails that were not spray painted with an X. And we didn't think to check for that. We didn't think people were doing more than what we'd asked them to do. So this contractor just asked me last week, he said, well, can I get that 38,000? And I said, I don't have that in my budget. I'm so sorry. I don't know what to tell you, but I think you did that for free, because we were very clear. We marked with an X the handrails you were supposed to replace. And so he's trying to tell a supplier now and figure out with his subs what to do, but that was his mistake. And so it's crazy to me that people cannot follow systems, but now we know that we have to have them check the list every single week. And not only do we have to ask, are you doing the work we asked you to do, but make sure you don't doing anything we didn't ask you to do.
Yeah, so you saw the email I sent out this morning to our managers and every week on the calls from now on, the managers will be asked a very simple question, either by email or by Zoom. Is there anything in the last month or 3 months that has not been paid in real time that's going to hit now or in the future? Is there anything, utilities, anything that happens usually recurring every quarter, semi-annually, that is going to hit that we don't know about that will affect cash flow? Is there anything happening in the government, in the city or county, things happening that could affect cash flow? Is there anything in the world that will negatively affect cash flow, period? That's it. And this is not just for 2023, this is forever.
Mm-hmm.
So these kind of little things will never happen. And if they do, it's going to come out of the management company because we're asking them and telling them very clearly exactly what we're wanting.
It seems obvious that we would want to know if cash flow would be affected. It seems obvious.
They're not business people. They're managers.
Yeah. So they're not forward thinking into what our cash flow is going to be. They're kind of just doing their thing. So no, I think those are, you ask better questions. You want better results, you ask better questions. We're just going to keep asking those better questions and honing our systems. And so I'm really excited for 2023. One other really big announcement, Michael, is that you and Lyndon and I and Rand. So for those of you that don't know, Rand and Michael Young are two board members. Basically, their experience and systems and business acumen have proved invaluable for us. And so Lyndon and I have decided to pay them to not just be investors, but now pay Michael and Rand to be board members and advisors for us. And so we've actually decided to move forward on a partnership with a fund here in Utah. They've committed just over 70 million to the Multifamily Investment Club for the next year, 20 million coming up in January. So we're looking to put two large properties, probably in the $20 to $25 million price range each, under contract in January, February. We've negotiated so that MFI past investors can invest alongside of us. And that's really important to us, Michael, that Rand have equal opportunity to invest alongside this fund, and every other one of our investors and friends as well that can invest alongside this fund. So the fund has seen these deals. They've seen really how we've handled the challenges of these deals. No one's perfect. There's no perfect deal, but they really like how conservative we are. And I'm sure when they hear what you just said, Michael, they'll be really excited too, because they're like me. They're super anti-risk. They really don't want to lose money. They want to buy good assets that don't have to be perfect, but they have to be run well. And so they're really excited to work with us, where I think we're more excited to work with them, and it'll allow us to buy some really good deals. So huge announcement for us. We have two other funds that would love to work with us, that have, one is committed 100 million to MFI. I think these guys here at Seraph Financial are going to be our top investors and partners for a while, because we align so well. They're anti-risk. They don't need unreasonable returns, unreasonable fees. They're looking to buy low risk, long-term deals. And I'm excited. It'll be great. So I'm sure you'll meet them. Oh, you're going to meet them. They'll actually be at our investor dinner, Michael. So I'm sure you'll meet them. But we may actually fly out to San Francisco and do a meeting. So we'll keep you guys updated. But Merry Christmas, Happy Hanukkah, everyone. Happy New Year's and happy holidays. Feel free to reach out to me about anything. And we're just going to keep plugging along, keep building our systems, and keep hoping and praying that rates come down a little bit.
Amen.
Okay. Thanks, Michael. Thanks, Chad. Thanks, everyone.
Thanks. See ya.
See ya.